One of the worst performing sectors over the past 12 to 18 months has been real estate, or the REIT sector. Reason being, they're a very sensitive sector to high interest rates, something that has shot up over that same exact period of time. However, what's on the horizon, although it may not be here as soon as many thought, is lower interest rates, something that bodes extremely well for this interest rate sensitive sector. As such, I like to refer to this period we're in right now as the accumulation phase. You can accumulate more and more shares at extremely discounted valuations, knowing that on the horizon, eventually interest rates will come down. And in today's video, we're going to take a look at 3 high-quality REITs trading at extremely cheap valuations, all with 20% upside over the next 12 months or so. So before we begin though, make sure you smash that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before I begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now you can go to fool.com/Mark to sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at 3 extremely discounted REITs. Beginning with REIT number 1, which is VICH Properties, stock ticker VICI. If you've watched any of my prior REIT videos, then you know I love VICH Properties. After all, it's my largest individual REIT holding. The company has a ton of fantastic assets, and we're going to look at those here in a second. Let's first look at VICH, the stock. VICH currently has a market cap of $30 billion, and over the past 12 months, the stock is down 10%, with all of that coming here in 2024, because that's the exact performance of VICH stock this year, down 10%. Which down 10% isn't terrible considering how some REITs have performed, which largely speaks to the quality not only of the company's assets, but its tenants as well. VICH owns a portfolio of casinos, hotels, and golf courses all across the US, and they're also the largest landlord on the Las Vegas Strip, with many assets you're probably very familiar with if you've ever visited Las Vegas. Some of those include the likes of Caesars Palace, Mandalay Bay, the Mirage, MGM Grand, Park MGM, New York, and many more. In addition, the REIT works with some of the best operators in the industry today. And to speak on that, during the pandemic, many REITs across the range and across the board struggled with cash collections as their tenants saw their businesses reduced or even shut down to where they weren't able to pay rent. Even the likes of Realty Income saw their cash collections drop to 50%. Wasn't the case with VICI, as they were one of the only REITs on the market that were able and proudly able to get 100% cash collections during that time, and they've been able to sustain that ever since they've been a public company. In addition to 100% cash collections, they also enjoy a 100% occupancy rate. So we have high quality properties that are leased out to some of the highest quality tenants on the market today, which is able to generate both stable and consistent cash flows year in and year out. Something investors love to see. That cash flow has allowed the company to continue to build out its portfolio and also pay a safe, reliable, and growing dividend. As you can see, VICI has a 7.6% CAGR over the past 5 years when talking about the dividend, and that growth rate outpaces its peers. Right now, you can earn a near 6% dividend yield at 5.8%, and the company has been growing its dividend every year it's been a public company. Now turning our attention to valuation, where analysts are expecting the company to generate 2024 AFFO of $2.24 per share, giving the company a forward price to AFFO multiple of 12.8 times. That compares very favorably to its 5-year average of 16.3. There's no reason not to expect the company to not be trading at its average multiple as rates come down, meaning we're talking about a stock price closer to $36 per share, implying 26% upside. Let's take a look at what analysts think in terms of price target, where they have a 12-month average price target of nearly $35 per share, implying upside of 20%. VICI is definitely a name for those looking for high-quality REITs. And that leads us to REIT number 2, which is Prologis, stock ticker PLD. Prologis is another one of my favorite REITs on the market, and it's actually a stock that's been performing quite well until recently when they issued earnings that didn't meet analysts' expectations. And although the stock kind of got away from me, I wanted to add more. It now has fallen right back into my lap, and I'm going to show you about that right here. As you can see, Prologis currently has a market cap of almost $100 billion. Over the past 12 months, though, the stock is down 15%, with much of that coming in the past week or so. As year to date, the stock is down 20%. So from that chart, we got a big drawback after the earnings report. So for those of you unaware, Prologis is a warehouse and industrial REIT. This is a way on the real estate side of things to play the growth in e-commerce. And if you're like me and you believe that e-commerce is going to continue to penetrate overall retail sales as those grow higher and higher, then Prologis is a great play to look for that. As you can see here from this image, e-commerce uses 3 times more logistics space than brick and mortar stores. So as those e-commerce sales grow, it is very bullish for the likes of PLD. And PLD is not just a US company. They have exposure not only here in North America, but also Central America, South America, Europe, as well as Asia. So why did PLD shares fall, you might ask? Well, when the company reported its earnings release, it had to lower its FFO guidance. Reason being, high interest rates. As new tenants coming in were a little concerned about those higher interest rates and the slowing US economy. Again, it's a near-term blimp. I'm a long-term investor looking to enter into positions at great valuations. In the near term, though, you can collect a nice growing dividend. The company now pays a dividend that yields 3.6% with a 5-year dividend growth rate of 12.6%, making it a rare dividend growth REIT. The REIT has increased its dividend for a decade straight. In terms of valuation, 2024 AFFO comes in at $4.42 per share. That's analyst expectations, giving the stock a price to AFFO multiple of 23.9 times, well below its 5-year average of 29.2 times. So slowing growth this year, but looking at this fast graphs chart, you can see growth pick up in the subsequent years. Now let's take a look at what analysts think in terms of price targets, where they have an average 12-month price target of $136 per share, implying upside of 28%. If you're a believer in e-commerce growth, PLD is worth a second look. Before we jump into the final REIT, let me take a moment to tell you about my 6-week Investing Accelerator course. Hundreds of students have already taken this course where you get to work with me one-on-one to develop not only a personalized strategy and action plan moving forward, but you're going to understand how to value REITs just like we're doing in today's video and more. And then from there, we progress even further into non-REITs, taking a look at the exact same way I analyze stocks using 8 to 10 different metrics, all with the sole purpose of determining whether that particular stock is a buy, hold, or sell. So if you're interested in learning how to work with me one-on-one over that 6-week program, check out the link down in the description below and see if there's any room with enrollment opening. And that leads us to REIT number 3, which is American Tower, stock ticker AMT. American Tower is a leading cell tower REIT that was hit extremely hard coming out of the pandemic. The stock was up as high as $300 per share, but then was subsequently nearly cut in half as it fell all the way down to $160 per share. However, to close out 2023, the stock soared higher by about 35%, but here we are looking at the stock today, and it has fallen right back into our lap. The stock currently has a market cap of $85 billion. Over the past 12 months, the stock is only down 5%. However, year to date, as I just mentioned, recent pullback, the stock is down 16% here in 2024. Well, the company did just give us an update to their latest earnings report, which actually beat analyst expectations, both in terms of revenue and FFO. Growth catalysts for these cell tower REITs continue to be coverage for many of these cellular providers, as well as 5G. 5G is extremely fast, especially the top band. However, it doesn't travel as far. So what is there more of a demand? What do you need more of then if something doesn't travel as far? You need another cell tower. 5G is the growth catalyst here in North America, but in less developed countries, they're still working their way from 3G to 4G, another growth catalyst for American Tower, which isn't just based in North America. They're a global company. In terms of the dividend, it will look very similar to that of PLD, as AMT is another rare dividend growth REIT. You get a 3.6% yield to go along with a 14.5% 5-year dividend growth rate and 11 consecutive years of dividend growth. In terms of valuation, analysts are looking for the company to generate 2024 AFFO of $10.42 per share, giving them a price to AFFO multiple of 17.4 times, which is extremely below its 5-year average of 25.8 times. There are very few times you can look back on AMT shares and see the multiple below 20 times, and right now it's sitting at 17. Analysts rate the stock a strong buy, giving them a 12-month average price target of $220 per share, giving that upside of 21%. AMT went through its fair share of issues, but as the premier cell tower REIT, this is worth a second look. So there we just went through 3 high-quality REITs trading at great valuations. Again, this is that accumulation phase. Don't expect to buy REITs today and expect them to be up 10% a week or a month from here. We need to look at the data, just like the Fed is, and determine when are interest rates going to start coming down. Because when we get word that interest rates are going to start coming down, REITs are then going to be off to the races. And these are 3 great names to start accumulating shares in. In the comments section down below, let me know which of these 3 REITs do you like the best? Would you be willing to add at these levels? And if you haven't done so yet, make sure you smash that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.